and welcome to this web conference to discuss both the FOMC meeting that took place overnight, but also some of the more important market trends right now. My name is Tai Hui. I'm the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and thank you for joining us this morning. So I'm going to split my presentations into three parts. The first part is obviously going to review what happened last night in terms of the FOMC. And then secondly, I just want to quickly touch on an update on the U.S. Iran situation and where do we think things are likely to go in the coming weeks and months. And the third part will be just a quick recap of the U.S. first quarter earnings season, some of the key messages, and also what does that mean for investors. Now, in terms of the FOMC, no change in the policy rates as expected, 3.5% to 3.75%. I think the key change in the statement was very much in terms of the inflation language, upgraded from somewhat elevated on inflation to elevated. So that very subtle change does reflect on the more challenging inflation environment because of the pickup in energy prices. If you look at the March inflation data out of the U.S. as well as some of the other markets around the world, we are starting to see that pickup in fuel costs being reflected in headline inflation around the world. And I suspect that the risk is as we progress through April, May, second half of the year, more inflation pressure could build up, not only in terms of fuel prices, but also potentially as food costs start to rise, that again could eat into high inflation. The hope is that this will not generate a second round effect on inflation, but I think the risk of that taking place is starting to rise as the Strait of Hormuz remains closed for the foreseeable future. So again, I'll come back to that in just a second. Now, in terms of the FOMC committee, Stephen Merritt, who's been voting for rate cuts since he joined last year, he still voted for 25 basis point cuts, despite all the inflation concerns. There are three FOMC members who agreed with no change in the policy, the policy rates, but they opposed in keeping the easing bias in the language, arguing that inflation backdrop is no longer supportive of that easing bias. So in that sense, you are seeing a greater division within the FOMC, where one member is voting for a cut, and then three is really not thinking very much about rate cuts at this point in time, and the remaining members are sort of in the middle. So in that sense, I think that greater division, it does reflect a couple of things. Number one, the global and the US macro environment is becoming more complicated because of that increase in fuel costs. But at the same time, if I take a slightly more positive glass half full attitude, it does show that the FOMC is independent, where members are looking at the macro numbers and the future trends and devise their policies accordingly. So from that perspective, I think a lot of concerns with Kevin Walsh coming into to be the chairman in the middle of May, and the fear of the Fed gradually losing its independence, at least from the position of FOMC members overnight, that's not the case. The overall independence, the ability for the committee to think or to decide on policies based on data, that is still very much intact. Now, a couple of other takeaways from the meeting as well as Chair Powell's press conference. As I mentioned, Kevin Walsh was confirmed or will be confirmed as Fed chair soon. The Senate Banking Committee did approve or okayed his nomination, which will then be voted by the Senate very soon. That means he will assume the head of the role of the Fed chair in the middle of May. As a result, Jay Powell will step down. So yesterday's meeting was his last meeting as Fed chair, but he did mention that he will remain on the board as a governor after his chair term ends on May 15th for a period to be determined. I think his reasoning is very much due to the administration's ongoing legal attacks on the Fed. I think he's staying around really, again, reflect on his desire to protect the independence of the Federal Reserve. But he did mention he will be supportive of the incoming Fed chair, keep a low profile, and avoid any shadow chair dynamic. So, by stepping down from the chairmanship He will be a board member. He'll be a voting member. But I think, like many senior changes that you see in organizations, he will try to avoid being, still in the shadow, influencing decisions. Now, as I mentioned earlier, I think the key here is the fact that the U.S. economy is still facing a number of inflation concerns. Not only fuel prices risen significantly. If you look at, for example, average gasoline price in the U.S. before the war started at the end of February, it was below $3 per gallon. Right now, on average, it's about $4.18. So that's quite a substantial increase, about 40% pickup in gasoline prices. And on top of that, tariffs, albeit the Supreme Court did strike down the IEEPA tariffs or the reciprocal tariffs back in February, but obviously President Trump has replaced that with a Section 122 tariff of 10% that will continue until July, when the 150-day extend or the 150-day tenor ends. But at the same time, as you've seen in the last few days, the Department of Commerce, as well as the USTR, the Trade Representative, they're also deploying Section 232 and Section 301 to investigate unfair trade practices by trade partners, whether it's China or Europe or India or Brazil, as well as a number of other category of products. So the tariff inflationary impact is not going to go away completely. So all in all, I think that's partly why the Fed is still on guard for inflation risks for the U.S. economy. So I think from our perspective, in terms of the Fed policy outlook, we think the Fed is likely to stay on hold for the foreseeable future. If you look at the futures market before the meeting, they're expecting really no change until 2027 summer. But after the meeting, there is a slight pickup in probability for a rate hike by the Fed later in the year. Still very small, but the very subtle change in market expectation is noteworthy. We think that the policy stance is still neutral. And I think that, again, allowed for some degree of wait and see by the Fed in the coming months. I think that's very consistent with what we're seeing. For example, the Bank of Japan decided to keep policy rates unchanged also this week. We've got the ECB and the Bank of England tonight. We expect them to, again, keep policy rates unchanged, albeit leaving the door open for potential increase in policy rates if inflation does take hold. So overall, I think because of the situation in the Middle East continues to be pretty fluid, central banks, I think it makes a lot of sense for them just to pause and wait and observe before acting. Don't forget, policy rates or any change in monetary policy often takes 6 to 9 months, if not longer, to take effect. So, even if a central bank decided to change their policies today, the impact will come towards the third quarter or the end of the year, if not in 2027. So I think central bankers have to be very mindful of, pulling the trigger a bit too early. And also at the same time, don't forget the demand destruction that comes with high energy cost will also be part of the consideration as well. So I think central bankers is in a really difficult spot when it comes to thinking about how they should execute monetary policy, because of both the upside risk to inflation, but also the potential downside risk to growth in the months and quarters ahead. So that's the Fed. And then when we come to the situation in the Middle East, look, let's be honest, there is at the moment no clear path to reopen the Strait of Hormuz at this point. While the U.S. and Iran may be in a ceasefire moment, but the reality is they have yet to come to an agreement on how to resume traffic or shipping through the straits. That to me is the most urgent part from a market and economy perspective. Whether the ceasefire will hold or negotiation over nuclear programs from Iran, I think that will take a long time. Don't forget, the U.S. and Iran did go into negotiation last year and early this year, but both of those negotiations ended with the U.S. attacking Iran nuclear facilities back in June last year, and of course the more broader scale of missile strikes alongside with Israel in February or late February this year. So clearly the level of trust between the two sides is relatively low, and therefore the prospects of reaching a sustained agreement is going to be time-consuming and very challenging. But for us, from our market perspective, the most urgent aspect continues to be the blockade of the Strait of Hormuz, where at the moment, if you think about the supply disruptions, by April is about 14 million barrels per day. So I'm sure you've all read the data that about 20% of global energy supply goes through the Strait of Hormuz. That is approximately 20 million barrels of oil, but some of that has been mitigated by the inland pipelines within Saudi Arabia, that the product is being shipped towards the Red Sea and that comes through the Red Sea. But that's about 6 to 7 million barrels a day. The remainder of that 20% of that 20 million barrels still have to go through the Strait of Hormuz. If you're producing out of Kuwait or the UAE, there's no pipeline at this point, or there's no bypass of the strait. So the supply disruption is clear, and it's not just crude oil or natural gas. A significant part of global fertilizers ingredients, things like urea, ammonia, sulfur, also goes through the strait as well. So as a result, the supply of fertilizers is also being impacted, the cost is increased, and therefore the demand destruction on energy at the moment from our investment bank research colleagues, they estimate that to be around 4 million barrels per day. That includes petrochemicals, that includes a reduction in demand, for example, jet fuels. We've seen airlines both in Asia as well as Europe starting to cut flights or reduce flights because of the increase in fuel costs as well as reduced supply. So those type of demand destruction is taking place, but again, $40 million barrels in terms of supply disruptions versus 4 million barrels per day in terms of reduced demand, there is still a significant gap in terms of the shortage of the markets that we could see in the weeks and months ahead. And don't forget, as I mentioned earlier, the demand destruction here is not free. It will impact on global economic activities, from travels to agriculture to petrochemicals, and then a downstream production, industrial production. For example, if you do have PVC or plastic, then a lot of production, whether it's auto, consumer goods, that could be impacted as well. So I think the concern here is not only on the inflation side, but also on global economic activities, even though global dependence on oil as an energy source has declined over the years, but nonetheless, as a raw ingredient to a lot of our production, that is still somewhat irreplaceable. So I think the risk we see is obviously, so the core scenario remains that the strait could be reopened in the next 1 or 2 months. That'd be the ideal scenario. And after that, I think it would take another 6 to 8 weeks for global energy flow to resume to close to normality. But the risk we see is, as this continues to drag on, the potential impact on the global economy will continue to rise, especially as strategic reserve is being drawn down, and therefore the rationing of energy as well as petrochemicals could become more severe. Hopefully we don't get there, but I think that is a risk that we should start to become more aware of in the weeks and months ahead. Now, that said, if you just listen to what I said a few minutes ago about the downside risk to growth, upside risk to inflation, that is not a particularly attractive scenario for investors. The stagflation concerns, I think that's something that a lot of investors are starting to be aware of. But if you look at the market performance in April for equities, both S&P 500 and the Nasdaq index hit record high in April. If you look at the performance of Northeast Asian markets like Taiwan, South Korea, the semiconductor theme was extremely positive, driving a lot of the market momentum. And that seems to be a disconnect between what I mentioned earlier about the geopolitical and economic impact coming out from the Middle East, but yet market seems to be taking a much more constructive view. Now, how you square that round peg, I think the key here, I think, from our perspective, is investors are taking a long-term view of AI and earnings, and they believe that, while we don't know exactly when Australia will be reopened, in the longer run, the development of AI will continue, and they'll continue to deliver earnings for those who own stocks in, whether it is in technology or hyperscalers, or in terms of companies that make the GPUs and CPUs, or the companies that makes the components that goes into these CPUs and GPUs. So from that perspective, I think that's how investors are thinking about, or blocking out the short-term noise, thinking about the long term, which I do think it makes sense. But as you probably see in the next few weeks, if we continue to see a blockade in the Straits, market volatility is likely to pick up. And that comes to the next point, which is the latest round of corporate earnings coming up from the U.S. Now, S&P 500 in terms of market cap, we are about a third of the way through the earning report season for Q1. And earnings growth right now for this quarter, or for the first quarter, is around 14%, which is still a very impressive number if you think about the long-term average of U.S. corporate earnings, or S&P 500, is about 7%. So the fact that we're still double of the long-term trend as of Q1, that is something I think justified the market buoyant mood as of now. If you look at by sector in terms of contribution, no surprising where technology is doing most of the heavy lifting, but at the same time, financials and industrials are the other two sectors that are also delivering earnings that contributes to overall S&P 500 earnings growth. And in technology, information technology, and financial industrials, those earnings growth is being delivered by both margin expansion as well as sales or revenue growth. So it's a reasonably healthy set of numbers as of now. And then again, partly why we've seen the U.S. investors or investors in U.S. equities seems to be in pretty buoyant mood. And again, I think that's also being mirrored by what's happening in Taiwan and South Korea. Some of the leading tech producers or tech exporters, the recent earnings numbers have also been quite impressive. And that again helps to justify market optimism. Now, if you break it down into the individual companies, now I can't name companies obviously, but if you look at the behavior of investors when they look at corporate earnings, a couple of takeaways. Number one, the revenues and the income growth of tech companies continues to be strong, especially from cloud services. So no surprise there again. With AI, with the demand for data centers, those with the infrastructure, with the data centers, they are likely to reap immediate benefits because demand for compute is there. Secondly, but in reverse or in contrast, investors continue to penalize increase in capex, especially if they don't believe in the products those particular companies are generating. So, for example, I mentioned this in the last few quarters. You are going to have a number of hyperscalers producing or creating models. Some will be popular and adopted. Some will be behind, and investors or also consumers and companies may not be looking at them as favorably. If, for example, a company with a less attractive or less competitive model, but they're still spending heavily in capex, I think investors are likely to penalize this company more. In contrast, if a company is producing a model that's competitive and that's being embraced by consumers and businesses, I think they have a bit more leeway in stepping up their capex. So I think I think investors are asking the right questions about how they should be assessing the ability for these tech companies to monetize their AI models and developments and therefore the capex spend. But I think they're also doing the differentiation when it comes to the competitiveness of their models and products, and more importantly, how they monetize those competitive or less competitive models and AI processes. So to me, this type of rational thinking does not indicate a bubble. We can always argue and debate whether valuations in particular companies or sectors are high, but the fact that investors are asking the right questions, to me, it certainly satisfied or rather, it certainly satisfies the criteria that we're not in a bubble. Bubble is not just about valuations, but also about investing carried away about the benefits of particular innovation, and using that to justify or even make excuses of high valuations. The fact that I think investors are making quite rational differentiations amongst different companies, that to me is a relatively healthy sign. So in summary, a couple of things. Number one, from the Fed's perspective, no change in the foreseeable future. I think they will monitor inflation very intensely in the coming weeks and months, especially if inflation is creeping into production of goods or the cost of goods as well as services, and not just being limited to the supply side, which is fuel and food. The independence of the Fed to me is still intact, especially considering two things. One, Jay Powell staying on as a governor, that provide additional integrity or a framework for the Fed. I think it's very respectable for him to mention that he's going to be a member, but not a shadow chair. I think that, again, is important. So he's not creating conflict within the Fed. But the fact that Fed members are expressing difference in opinion, that to me is also really important as an illustration of Fed independence. So that's the good news. In terms of the situation in the Middle East, unfortunately, there's not a lot of clarity in terms of when the Strait of Hormuz will be reopened. Obviously, we hope it will be soon. But the longer this continues, the risk of energy prices staying elevated, Brent is already $118 right now, the risk of the stagflation pressure continue to build will rise. And that puts central banks, not just the Federal Reserve, but central banks both in developed markets and emerging markets, in a greater dilemma. Fiscal policy is likely to remain accommodative and supportive. We've seen many governments, both in developed economies and emerging markets and Asia, using subsidies to help out businesses and households to get through this period of elevated energy prices. Hopefully, again, this is short term. But if this is sustained for a quarter or two, clearly this will add to the fiscal deficit pressure of many governments around the world. In corporate earnings in the U.S., so far so good. The sectors that we've been highlighting, not just technology, but financials, industrials, those are net contributors to S&P 500 earnings. So that's great news. But at the same time, when it comes to technology, I think investors continue to benefit from strong underlying performance of earnings, but at the same time, they are applying a critical view on companies' capex. But more importantly, is this capex going to lead to a product that is competitive in the long run? So I think that assessment continues to call for active management when it comes to earnings. So finally, in terms of investment recommendations, nothing really changed. We're still thinking or believe that the pro-risk on tilt continues. Again, while we do recognize the short-term volatilities from extended period of blockade in a strait, and therefore the risk of elevated energy prices in the next few months, our risk on to or pro-risk approach towards equities remains, and not just in the U.S. but also in Asia. Our preference for Northeast Asian markets, Taiwan, South Korea, even selected companies in China and Hong Kong that relates to AI continues. And for fixed income, while bond yields have picked up, but we still prefer the short end of the yield curve or government bond curve because of the uncertainties when it comes to inflation. But as I mentioned earlier, the risk of higher fiscal deficits as governments try to help out households and companies, that could again impact the long end or have an adverse impact on the long end than the short end. We still like high yield corporate debt because of the relative resilience of company balance sheets in this segment. But at the same time, the all-in yields when it comes to high yield corporate bonds remains attractive. We think that income component continues to be super important when it comes to contribute to overall return when the price of bonds and equities could be a bit more volatile in the weeks ahead. Finally, on alternatives, infrastructure, transportation, that continues to be key generators when it comes to income. And the fact that global trade is being disrupted because of the situation in the Middle East, it does imply that shipping demand, if you think in terms of distance traveled, is likely to increase because ships have to go a longer way to get around some of these blockades. So, I'll never want to use the word benefits when we're talking about geopolitical situation for wars, but I think transportation is quite a useful way to hedge your geopolitical risks, as shippings or ships have to go through longer routes in order to get from producers to customers. And of course, that also requires additional infrastructure, as more ports would need to be built to satisfy the new shipping routes, to meet with new different demands. For example, could Japan, Taiwan, Korea demand more fuel from the U.S.? Maybe. But at the moment, the U.S. does not have the necessary infrastructure to deal with an increase in shipments for natural gas and oil from the U.S. to Asia. So again, this could create additional infrastructure demand in the U.S. as well as globally as supply chain continues to evolve. So that hopefully wraps up some of the key takeaways for this particular call. And finally, thank you for joining us today, and I look forward to your next participation in our conference or web conferences. Tai Hui, I'll see you next time. Thank you.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from J.P. Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. J.P. Morgan Asset Management is the brand for the asset management business of J.P. Morgan Chase & Company and its affiliates worldwide.